right. Okay. Hey, everybody. Thanks for joining us. Today, we're going to talk about a 24 unit deal that Mike and I purchased a few months ago. And, it's just going to be kind of informal, educational. We're just going to go through, how everything that we did to put this together from start to finish. We feel like it was a pretty special deal. I've bought a number of properties, myself, and this one definitely stands out. And we get a lot of questions from people that we talk to about it, like just how did it come together, all the details. So we thought that it would be a good educational and informational session to do for anybody that's curious about buying real estate, or anybody that already buys real estate, just because it's fun to talk about, right? Okay, so let's see. Before we get into that, a little bit about us. This is me, Pete Schnepp. I'm the founder of Asset Stream Properties, which is our real estate investment company. I'm in Phoenix, Arizona. I've been buying real estate here in Phoenix for almost 20 years now. I've got a portfolio of single family and multifamily. Small multifamily is mostly my niche, but really I'm an opportunist. I'm a capitalist, and I like deals. I'm also an entrepreneur. I've got another company called Envision Service Group that I've had for 20 years that does painting and roofing services here in Phoenix. And also, we've got a couple clients that send our guys across the nation doing different projects. And I built and sold a pest control company a while back. I've been a licensed realtor for a number of years. And I'm on a journey of buying real estate and making deals. And so it's a little bit about me. If you'd like to learn more about me, we'll share a link where we can connect. And then Mike, my partner on the Woody Creek project. Mike, you want to share a little bit about yourself?
Yeah, thanks, Pete. Appreciate you having me on here and being able to speak to everybody. Yeah, I've been really in real estate for about going on 10 years now, at least close to it. I was in the real estate space. And that's what got me started. I became a commercial agent in Marcus and Millichap and had a very successful career in mobile home parks. I sold over 255 million in mobile home parks, and I just started seeing how the whole business worked, and I wanted to get on the other side of it, as you did too, Pete. Get out of the rat race. And yeah, so my background was really starting off in the management before I got into real estate. So I understand how to navigate, complex transactions when it comes to real estate, and really understand the operational efficiencies of managing properties. I've flipped and fixed and flipped homes before. I ran a construction and painting business similar to what Pete had, and that's what got me to understand hands-on and tile work, drywall installation, and home remodeling. And that's what you'll see there on the entrepreneurial background and in this slide here. So I've also maintained a large fleet of tractors and trailers at YRC Freight. I did that for a number of years. So I have a lot of management experience. And when Pete and I discussed the 24 unit, he was like, "You're the guy to be on the ground." So I actually uprooted my family from Arizona to be right here on the property and oversee all the renovations going on. A little bit more about my early years and what's driven me and what keeps me driving and persevering is I have a very successful wrestling background. I wrestled in high school, became a two-time state champ, and moved on and went to Michigan State and became a varsity letter winner there in Michigan State. So I still continue to do that. When we moved to Indiana, I now coach my sons and my daughter's wrestling team here in Crown Point in the community, and this is really my hometown. So it's a small niche town, and we'll get more into why we decided to come here in Indiana and invest in that 24 unit. But that's everything in a nutshell for me as far as my business skills and my business assets.
Cool. Thank you, Mike. All right,
You
so we're
got it,
going to get
Pete.
started. Before we do, I just want to mention coming up soon, I'm doing another online event that's really cool with my favorite self-directed IRA company, and it's been a a pretty fascinating journey with my IRA, being able to unlock those funds from the stock market and put it into stuff like real estate. So if you're interested in checking that out, I'm going to put the link here in the chat if you'd like to sign up for that. That's coming up. When is that, Chelsea? November 20th?
Yep, that is next Thursday on the 20th, 11 a.m. Pacific.
All right, cool. All right, so this project that we bought, like I said, I'm in Phoenix. This project is in Indiana. Here's just some brief overview, and then really, I just want to screen share and just kind of show some things that that Mike and I went through when we were going through this. And if you have questions along the way, put them in the chat because we'll hit them as we go, and then afterwards we'll do some Q&A. So really, anything and everything that you're curious about, just throw it in there and we'll talk about it. But here's kind of a quick overview. It's 24 units in a town called Schererville, Indiana. This town is about 40 minutes outside of Chicago. It's right across the border in Indiana. It was built in 2012. We bought it from the lady who built it. She was kind of an out-of-state owner. I think she was living in Florida. She had a property manager there. The units are all 2-bedroom, 2-bath, about 1,300, 1,350 square feet. They've got a garage. And they were all rented for like maybe 1,450 to 1,550 a unit. The lady had owned them outright, and she was doing well. She had a successful career, and she had already made her money on it. But these units were really, really nice. I mean, these are big. They're more like condos than apartments, but they are apartments. But it's 24 fourplex buildings essentially, and so that's kind of a quick overview. So let me see what we got next here. I wanted to talk a little bit about, I'm going to show you a Google Maps view of this property. So this is across the street from, and it's a big open area with a church. And then over here is the property called Woody Creek. And so I'm just going to leave this here. Mike, you're the one that found this deal. And so I wanted to talk a little bit about that because that's the first part of any deal. Like, well, how did you find it, and how did you structure it, and so on and so forth. And Mike, you mentioned that you've got a background with Marcus and Millichap, and you've just got this like record of cold calling and finding property owners to sell mobile home parks, and that's kind of the strategy that you used here. So, can you walk us through like how did you find the property? Like, what program did you use?
Yeah.
Who were you calling? Who were you targeting? Like, back from the beginning when you started looking for a property out here.
Yeah, absolutely. So what transpired, especially the training that I received from Marcus and Millichap, was always, dive in, get the information, and then hit the ground running on cold calling. That was really Marcus and Millichap's strategy when you start off. And I use really the same concept. I'm just a little bit more efficient now than what I was when I first started out. Because when you first start out, it's very difficult to figure out, anything that you're doing because it's brand new and you're hitting your head up against a wall. But now that I've been doing it since 10 years, it's really quick to develop a system and a funnel for sellers or potential properties that you're looking at. So it took me about, I would say, 3 months to develop a cold calling data sheet that I had just in our market, and I used some high level programs to get that built.
Give us an idea. What are some of the programs that you use?
Yeah, so one of the big programs that I use is Reonomy. Reonomy is really nice software that you just click and kind of feel around and get ownership information. But I do use some other free platforms that'll help with LLCs and uncover, ownerships. I do have other programs called Checkmate to find out ownership information. But it's been doing this so long, skip tracing for me is very easy, and finding ownership records and finding ownership details. So that's what takes, an experience.
When you started, Mike, what were you looking for when you started using those softwares out here? Were you looking for a 24 unit?
Absolutely not. No, I was actually looking to just buy a smaller multi-unit and start cold calling the smaller stuff. And in Northwest Indiana does have a lot of the smaller deals. I think they had around, we'll call it 1,500 units in Indiana total. And if you break it down to those little 4 or 5 units, or even I would say duplexes, triplexes and quadplexes, there's probably a whole lot more in that total. So that's what I was going to call on. And I actually found the 24 unit calling on a 4 unit because if you look at the parcels on this particular property, they're actually all individually parceled into duplexes. So that's what I thought I was calling on. And I ended
No,
up
they're
calling.
fourplexes. Yeah.
Yeah. And
They're
I
all
spoke with the
fourplexes. Like,
correct, correct.
sorry.
So I ended up reaching her, and that's when she told me, "Hey, I'm going to sell the whole complex to you." I said, "What are you talking about? I'm only calling on a fourplex." So that's how that conversation started.
Okay. So, all right. So you get the seller on the phone. So what does that conversation look like from the beginning conversation all through negotiations to finalizing the terms? One of the things that is special about this deal is the seller finance terms. Okay. And so
Hmm.
we bought this property 24 units for 5.5 million. The seller carried the note for 4.4 million. We put 1.1 down. But the seller finance note makes it extra special because it's interest only and it's a step up rate. So the first 2 years are at 3.25%. The second 2 years are at 3.75%. And the third 2 years are at 4.5, right? And so it's a 6 year note. Um, so I get a lot of questions like, well, why in the world would she agree to that? How did you come up with that? And so Mike, help us understand like those
Yeah.
conversations and how that came about.
Yeah, well, really, it was just it's straight, consistent outreach, and that's something that I learned through Marcus, as I was mentioning before. I was one of the pace setter winners at Marcus. It was a award that I got that, if you made a certain amount of calls and you hit a certain amount of metrics for the first 4 months, you would hit this award, and I hit that award, and I just used the same philosophy. I just kept calling with that consistent outreach, and I ended up meeting the seller and built rapport with her. Now, the initial call, just like every call with the seller, it's rough and you got to have some thick skin. And the seller was a little feisty on the beginning, but as I continued to build that rapport and create value and understand what she was trying to sell the property for, then it started opening up that dialogue. And then she ended up texting me on the back end a month later and said, "Hey, would you be interested at buying the property at X price?" I said, "Well, fantastic. I've got a solid lead here." And I started going into the metrics, started looking at, obviously what the property costs, started underwriting, starting to look if this actually makes sense and really starting to take a macro level view of what the market was rents were, if this can really make sense. And then Pete, you were the first guy I picked up the phone, called, and we met and we started discussing this particular deal.
Yeah. Well, tell me about the seller financing structure and the percentage and the step up rate. How did you get to that point?
Well, we when we were discussing the price, obviously when we looked at the rents, you and I were saying, wait, this doesn't make any sense because we're matching rental rates in the market, and she was well below those market rates. And when I went back and spoke with her, we're looking at the numbers, and I said, we're not even going to make a return on this. There's no way I can pay your top price if we're not going to get something in return on the back end. And it took some negotiating there. It took some conversations. It took a while before we can break through that hard barrier and that wall. And she started opening up and saying, "Okay, let's negotiate some avenues in the pricing structure and the contract, and then I can work with you on the back end on the seller financing." So I threw some numbers out. She threw some numbers
Mhm.
out, and we made it work. We made it work to where we got that blended rate.
Yeah. Well, that's the beauty of real estate. Like there's different levers that you can pull to try to structure, a win-win. And so, yeah, the rate that we've got, just to give everybody a quick overview, like, man, so the spread between our debt payment and our gross income is huge. It's bigger than any other property that I've bought, and I bought 20 something properties at the get-go. So our first month of ownership, we hadn't done any work. Two of the 24 units were vacant. So we had 22 rental units paying, and we had a gross income of about 40,000 a month. And our debt service payment is just under 12,000. So like when you go to a bank to get a loan nowadays, they're looking for like a 1.25 DSCR, debt service coverage ratio, meaning they want to see your rents are 25% over your debt payment. Well, we're like 3.5 times. We're like a 3.5. It's unheard of on a value add play, right? We hadn't even begun our business plan. So, that spread, that cushion is huge. And then just to think that we're going to make that spread even bigger, or we're already making it bigger as we go. Cool. So let's talk about a little bit about how we analyzed and underwrote the deal. Specifically, maybe jump into the comps a little bit, and then we can see what else we want to talk about here. But we mentioned that the units were rented for $1,450 to $1,550 approximately for a 2-bedroom, 2-bath. And I know in Phoenix, I mean, that's kind of market rate, maybe even a little bit high. And I'm thinking, man, this is in Podunk, Indiana. No offense, Mike, right? Uh, there's no way we're going to push these rents up higher. But the reality is these units are nice. They're big. They're 1,300, 1,350 square feet. They're more like condos. It's called Woody Creek because they back to like a little nature area. And so I was like, well, let's see what they could rent for. And when we started looking into that, like, that's when we realized, holy shit, there's something special here. And so we started looking at the comps, and the first thing I do usually is just hit Zillow, right? Everybody's got their different platform, but I'm not a realtor in Indiana, and you weren't at the time, Mike. And we're buying it direct from the seller, so we didn't have an agent to rely on. So, we hop on Zillow and we look up all the similar units in there and kind of look at the pricing guidance. And this is what we saw was, 1,650 on the low end, up to about 2,300 on the high end, 2,350, different square footage, price per foot. And so we're like, well, damn, what is the average here and what can we get our units at? Because I know that our units, even if we didn't do anything to them, they're better than most of them. So we came in with our rent target at 21.95, feeling like that was kind of right there in the middle of what was out there and based on the condition, right? And this is after renovations. So we felt like we were being ultra conservative because really by the time we were done with them, we knew that we were going to have the nicest units out there, right? So looking at the comps, digging into some of these others on Zillow, you've got the ones that are like the bigger complexes that are always available, and then you've got the ones right behind us which are privately owned, like the townhomes that are being rented by individuals. And once those get rented, they're off, so they're not really a comp, right? And so we saw places like this with older units, not very nice, but comparable in size, and they've got garages as well. And boom, you've got 2-bedroom, 2-bath units renting for 23 to or 22 to 2,400 bucks a piece, right? And so this is one of our comps there. And this is a bigger complex. I don't know how many units are there, but that was one of them. And here's another one. And so we look at this and all right, well, it's a 1-story. Ours are 2-story. There's no stairs within the unit, but there's definitely a perk there for a 1-story, not having somebody above you, and it's got a 2-car garage. So maybe this one has some features that are a little bit nicer. But again, they're renting for 2,100 and up, right? 2,300. So we're like, all right, well, there's an immediate way for us to bump our rents in the $2,000 range with doing very little work. And the more we looked at the comps to see what else was available, and if you recall, Mike, when we were looking at these comps, we'd look at them one day and then the next day they're gone, the privately owned ones. It's like, well, shit, they're actually renting pretty quick because every time we identified a comp, privately owned one, it was gone pretty soon.
Right. Yeah,
Um,
I remember that. They were gone pretty quickly. And some of the comps, even still that you're pulling up, could be a half hour away from us. Maryville. Maryville's a half hour away from Cherville. So that's putting you, a little bit further away from Chicago. And that's where we're pulling our renters from, the Illinois border. So you're going to see
yeah.
some smaller rents on the Maryville side versus Cherville Dyer. So we also had that added benefit as well.
Right, right. So then, once we kind of got comfortable with what we were seeing, and we're like, okay, well, we see this. Is this right? Well, we called up Colliers and we had a market study done, and this is probably after we were under contract, but we paid for a market study to see if what we were seeing was the truth, And so what they determined is they did their deep dive on the comps and they're looking at the bigger ones. You know what I mean? They're not looking at the privately owned ones that are on the market and off the market in a week, but even the bigger ones, the most comparable units were renting for 2,000 and above, you know, and it showed that the occupancy rate was 97 and 96% on these nicer properties, right? But for the most part, all of their comps were pretty good occupancy right here. And, they do their whole market study. We paid them a lot of money to come up with this, but really what this did was it validated and justified, right, Mike? Gave us a little bit of
Yeah,
proof of
absolutely.
what we were looking, validated and
Yeah,
justified that we can definitely
this
achieve, we could take these units that are renting for 1450 to 1550 a month and bump them to 2000 plus. There shouldn't be an issue is what we determined with this. Right. So that's one study we got was the Colliers rent comps. The other one is like, well, what's the absorption look like? What's the true occupancy? How quickly do these things actually rent? And so the other study they did was the market analysis. And with the market analysis, they compared Chicago Metro as a whole to the local submarket that we're at. And so this basically, again, it validated what we were seeing. So the local submarket here, occupancy for 2010s vintage, 96.4%, historical 96%, absorption rate is good. What we realized is that there's not a lot of supply in this area. It's what you would think of for a traditional Midwest market, right? Like a steady eddy. And then some of these things where it compares versus Metro. So this is the sub-market compared to Chicago Metro. All these green dots here are saying that the sub-market is outperforming Chicago Metro. And you and I, Mike, know that Chicago Metro, compared to the nation, has been one of the top performing markets for the last year or two, right?
Oh yeah, absolutely. Same with Indianapolis. Chicago's growing in rents. I just seen a new article released the other day. Oh, um, I also been tracking Indianapolis, one of the hottest markets, probably in the top 5 right now as far as rent's concerned. So we're right in the
Mhm.
middle of that in the corridor. So where folks don't want to pay the
Right.
Chicago prices and taxes, but they want the benefits of Indiana right next door. So that's what we're dealing with. Very stable market.
So that's what this shows. So the occupancy analysis is better in our submarket than it is in Chicago. And the effective rents, is lower than in Chicago. That's why it's red here, right? Because it's cheaper to live where our property is. And so that's exactly what we thought we were going to do. We're going to get Chicago workers living in our market, right?
Mhm.
And that's exactly what's happening. We're drawing people that work in Chicago who would have to pay probably 3,500 to 5,000 a month for a similar type unit in Chicago, coming out to Shearerville and renting our places for 2,000 to 2,500. And Shearerville is, I mean, it's an upscale kind of affluent neighborhood. There's a Whole Foods there. There's Cooper's Hawk Winery, BMW dealer, Mercedes dealer. Like it's a cool little town with things that you would expect to see like in Scottsdale, but also you get the local flair, right? Um, so anyway, all of this stuff, all, you know, the big data really just validated what we were seeing. And we had made the decision beforehand to go in escrow, but this, you know, it validates your gut instinct. This is the one unit we have for lease right now. So to date, we've leased out 3 of them that we've renovated, and the rents have ranged from 22 to 2,500. This one, Mike, we just put on what, like a week a week or so ago.
Is this, yeah, 1511 in 4 days, we had over 150 views. And today we actually have, as of today, 5 applications in, 16 leads, 297 views, and 23 saves.
How many applications?
We have 5 applications turned in, and we already have 1 renter that's already approved and ready to put a security deposit down. And that was in the first 4 days.
Yeah. So this is a first floor unit. You know, the first floor units are, some people want those more than the top, but the top floors are actually really special because they've got the bigger vaulted ceilings with beams. But let's talk about the renovations. And so when we were penciling this out, we're like, well, what are we going to do? The question is always, how much work do you do to maximize the rent value without doing too much work, right? So, and how much do we budget for CapEx? So we, you know, we started putting together our budget for CapEx, and we came up with a total budget of, for the interior, 25,000 per unit on the inside, and some extras for the outside, right? Paint. Yeah, we figure we probably have to paint it before we sell it in 5 or 6 years. And doing our due diligence, we realized we were going to need to do the seal coat on the asphalt. But 25 grand is, you know, that's a lot of money for a unit. I mean, these are bigger than normal. But what we also determined is, well, the first few units we wanted to do different spec levels, correct? And see how much do we spend versus what's the return. So with that said, this unit, 1511, we didn't, do you know what we spent on this unit roughly? And what did we do? And what did we not do?
I would say we did about let's say closer to 15,000 on that one. We updated the flooring. We did do some light fixtures. We did do outlets, paint, fresh paint all the way around. I believe that was it. This one was more of a less intensive renovation than the rest of them. So this was more of our bottom tier on the aspect of our levels.
Yeah. So we didn't do, you know, the shower and the bath vanities were like this. And we decided we aren't going to spend money on those because you don't really get you don't really get a great return on the rental value on those. And they were already, you know, they're not brand new, but they're in good condition. Those didn't need to be torn out and replaced. But really the biggest expense was the floor, the LVP floors here, right? And so this one, I don't know what this unit specifically was rented for before, but if it was 1550, something like that, we're going to get 2,200 for, that's a pretty decent return. Now there's another unit that we did where we painted the cabinets, right? And we replaced the countertops. And so that's really the full spec level. 25, 25, somewhere between 20 and 25, the one we painted the cabinets. Mike.
I'm sorry there. You just broke up a little bit. I caught what you said. It just went in fast motion. Yeah, that was 1515. We had that one pre-leased. That one was sold before we even put it on the market. That one was a full renovation, granite countertops, our blue cabinets we painted, full paint throughout. These are top floors. So it's really cool with the top floors. They have skylights. They have the top balcony. The tenants are paying more, and we wanted to charge a little bit more because of the cost to maintain those and the cost to fix those up as well. It does take a little bit more because we've got some layers in the ceiling. They're vaulted ceilings versus the first floor. That cost us more to paint and repair. So that's what these were worth more as far as rent or charged more. But yeah, that we did everything throughout the entire unit. And besides, the only thing we didn't touch was the vanities and the vanity tops in that particular unit. So, but yeah, everything else has
The other
been
one, yeah.
renovated.
Yeah, on the other unit. So, and that one's not, I don't have the pictures of that handy, but anyway, we've tested the units with different kind of spec levels to see, number one, what's our return, and number two, what is in demand. You know what I mean? And what we actually found was the one that we brought to market that was the nicest and the highest price, rented fastest, but the other ones are still renting really well. So I think the return is better, you know, when we're not doing the countertops and the cabinets. But I don't know. We're still kind of playing with that. We've gotten 3 renovated. This will be the 4th, and we've got 2 more coming to market soon. So let me see. Next up, what about, so we talked a little bit about the rent. We talked about the CapEx, the P&L. So some of the, you know, like when you're structuring a deal, there's a lot of levers and numbers you pull assumptions, right? And so that can be big. Your assumptions can make or break a deal. And so what we planned on, what are some of the things that we planned on with the assumptions on the P&L, Mike?
Can you repeat that, Pete?
What were some of the key assumptions that we played with on the P&L and the projections?
Um, we were, I know initially we were trying to figure out real estate taxes. We were trying to figure out the contract services and repairs and maintenance and the rents. Those are kind of bugging us a little bit. Um, when we came into the property, we started noticing that landscape was a big issue here, and it looked like as she was getting ready to sell, she may have done some cleanup work because you could see on the P&Ls that we looked at, we seen very low totals going across the last 3 years, and then a little spike, a little bit of a bump, about $6,000 or $7,000 on the landscape. Well, I know why now that I'm here on the ground, because Woody Creek definitely needs a lot of nurturing on the landscape where it gets wild. So that's what I've been battling right now. Um, but yeah, just when it came to this particular property, those are the significant areas that we were looking at when it came to underwriting and making sure we had ironed out, had enough room to make this particular deal work. And I know you mentioned that as well, Pete. You and I were both aligned on the underwriting, and we had to make sure those buckets were able to have enough room to make sure this deal made sense. And also the replacement costs, or excuse me, the reserve accounts too.
Right. Yeah. So like you've got your expenses and you start with taking what the seller provides you, and you always got to take it with a grain of salt. But that's like your starting point. And then from there, we went through a series of adjustments on what we think is realistic, right? And then the property taxes are going to change once you sell the property as well, figuring that out. Repairs and maintenance, you know, out there we do fire inspections for the fire sprinklers, so on and so forth. So we want to make sure that we've got um, adequate expense budget here that we're planning on. And, you know, some of the other key assumptions clearly were the rent and the turnover, right? And so this was a big thing. They were occupied. And so it's not like we're taking over a vacant building and doing the whole project at once. So what kind of income are we realistically going to bring in the first year? And so we had built out a turnover matrix. We figured, okay, in the first 12 months, we'll probably have 20% vacancy, which is, what is that? It's 5 units vacant at all times in the first 12 months, which I don't think we've had, I don't know. We've had probably 3 to 5 vacant at a time for the first 12 months. We're probably less than 20%, but then also how does that calculate to your average monthly rent for the first 12 months? So we came on this number. We've already bumped some, even people that we haven't renovated yet, we've already started bumping them just when they go month to month. We've bumped up rents to be like 17, 1800 bucks a month. Some of them, we're not trying to push people out, but you know, we're trying to time things, and if they're going to stay a little bit longer, then we definitely don't want them in there at 1450 a month. So we felt like this was a pretty conservative first 12 months. And then we factored on 3% inflation rate, across the board for rent and expenses for the first few years. And then what do we do? 4% in rent for the next three and 3% on the expenses again. But our top line average monthly rent, 17.95 for the first 12 months, 21.95 for the next 12 months. And then 22, I mean, I think what we're getting in rents already is going to blow these out of the water. You know what I mean? So I think we did that pretty conservative. And then based on ongoing vacancy, the second year we had a total of 10% vacancy and concessions. And then going on after that, we had 6% based on everything that we saw with the Colliers market data. 94% occupancy was spot on with the averages, right? And then we factored in our debt service and the cash flow available for distribution, right? And so this is kind of what the P&L looks like. And then once you've got your NOI set in place, what kind of value is the property looking at going forward, right? And so just kind of this is how we looked at the numbers. And after several iterations, we came on a final conclusion and we're comfortable with that. And so, all right, well, any investor wants to know what kind of returns do you get? Or would you expect? Like, how do you calculate that? And so everything calculates here. This is the project level returns. If everything hits exactly how we pencil it out, which never happens in real estate. If you've ever done a deal and sold it and it penciled out exactly how you planned, let me know because I would love to hear about that. But you've got to come up with some kind of projection to base your judgment on. And so this is what it looked like. If everything hits how we wanted to, and we sold it in 6 years, on the project level, it's what, 183% return on investment, average annual at 30%, IRR almost 22, average cash on cash at 10, and equity multiple almost 3. And so like with all the deals that I've underwritten over the years, like these are pretty darn good numbers for a multifamily investment. Anything to add on that, Mike?
Yeah, I really think that those that are on the call right now, I don't know if they really understand what you and I were going through in the middle of all this and trying to figure out, the returns. We were really stress testing this. We're looking at all the market comps. We were looking at taxes, insurance, utilities. I mean, you name it, snow removal. You and I were both living in Arizona, so we had no idea how much all these things are cost, each line item. So we had to use our experts out there. So we were looking at Colliers, we were looking at Zillow, U-Haul migration data. I know Chelsea had sent us over that report, which was cool. And these were some of the things that we were doing just for the sanity checks, that we were trying to find and make sure we believed in these numbers that we worked so hard on. And it took us both a few months to dive in and make sure everything was solid. And that's when when we went under escrow and we got the Colliers report, that's what really gave us a breath of fresh air. And that's why we paid for it. And it made us very comfortable to see that, wait, all these line items that we underwrote, or even conservatively, we're going to be making out a whole lot more money than what we have underwritten. So we did a fantastic job. That helps us understand the market, understands that we know what we're doing, and we can be confident to share these numbers with our investors.
Yeah. All right. Good stuff. So let's move on. We're going to talk a little bit about post-closing, some of the stuff that we've gone through. We've got 15 minutes left. And so if you're listening in and you've got questions, punch them in the chat room so we can hit them. But so we closed on this property in April. Let's talk a little bit about what's happened since. We had a big surprise right after we closed, right, Mike?
Oh,
Go ahead.
yeah, we
Why don't you
did.
talk a little bit about that? Yeah.
Yeah, so we did everything we could in due diligence to make sure we investigated all the major components. We did roof inspection, HVAC inspection. We walked the property, we checked the foundation, we checked the streets, and realistically, when accidents happen, we just want to make sure we have protections in place. And we did have the proper protections in place, but we did have a water leak disaster in one of the water heaters on the top floor. We mitigated it pretty quickly. We got a phone call, I'd say probably about 3 weeks into the property, and we were shocked to find out what happened. In the unit upstairs, the tenants, actually it was the lower tenant, one of the tenants' dog sitters came into the unit and called the property manager and said, "Hey, my unit, or the unit that I'm in is currently flooded. We've got about a foot of water sitting in the unit." And they immediately called me and I had to do the investigation. And what happened is both tenants were gone on vacation, unfortunately. And the upstairs water leak, uh, it expanded and actually ripped open, and 40 gallons of water leaked out all over the top unit and fell into the bottom unit. And I still didn't have any understanding of what the damages would actually be. And until the remediation team, we called the remediation teams, they went out there. It was over the weekend, so it was difficult to find guys to go out there and on the weekend and still give us a good deal. But we were able to contract a very good, reasonable company out there, and they did dry it up for us relatively quickly. It took about 3 days, and we actually had to file for the insurance because we had significant water damage. And I don't know the number offhand. I said it was probably around $25,000. But the good news is we were able to renovate both units. And 1515 was one of the units that we fully renovated. And we got leased up at over $2,500 per month, and that was pre-leased. And we're working on the bottom unit, 1513, and that one should be done here in the next week or so. But that was a full renovation from top to bottom, full, all new light fixtures, drywall, paint, cabinets painted to our unique blue signature look in the kitchen, granite countertops, LVP flooring throughout. We did all the light fixtures. It is a beautiful, beautiful unit to see. I can't wait to release those photos, but I think we'll have that one leased up right away. But go ahead, Pete.
So we had a flood emergency situation, right? And so
Yes.
we dealt with it, which was really tough, right? We dealt with this for weeks, but I mean, those people couldn't live in those units, right? They couldn't live in the units. So we had to shift one person. We moved over to one of the other vacant units that we had that we had at closing, right? We just cleaned it up for them and moved them in. The other unit, well, she temporarily moved out, and then based on the lease, we could enforce an eviction because we needed time to redo that unit. So it almost helped our turnover schedule, get 2 vacant units ready to go, right? And then the insurance is covering the renovations on those, so that was added cash that we didn't need out of pocket. And then also one of the good things that I like about our insurance program that I get on all my properties is loss of rents coverage, business income. And so we haven't even filed for that yet, but we'll get that pretty soon here. And probably next year, the insurance will go up a little bit, and that's to be, that happens. But I think in the long run, the benefit, it actually helped us. Let's talk about the property management. So as we were going through this, we had interviewed a few different property managers, and we selected one that we thought was really like the best one. And now we're changing. We're switching up. We're not happy with them. They're not performing to our expectations, right? And so what can you share about that, Mike?
Sorry, Pete. It looks like I'm having a little bit of internet difficulties. Can you repeat the question? It looked like it was breaking up there on the question.
What can you share a little bit about the property management company that we hired, what we expected, and the shortfalls in what we were getting, and why we're making change now?
Hey, Pete. So just to kind of confirm the question, because I'm still having, I don't know if you can hear me. It sounded like you,
I can hear
okay,
you.
perfect. It sounded like you wanted to know a little bit more about the property management and what we expected on the front end.
Yes.
Yeah, so we lined up pretty solid property management companies right on the front end. We had 5 of them that we were kind of trying to figure out what fit our needs best. And we had calls with each one, in-person interviews. And when it came down to, we selected one of the property manager based on their flexibility, allowing us to, being able to maintenance the property, as well as, get some insight onto, if they're going to bring a technician, allow us to see what that is and see if we can put in a bid as well. We needed that flexibility because I was going to be here on site and, help save some costs there. And they fit the bill. They sold us that, they were the people to do the job. And we ended up selecting them because of that flexibility. Most of the other managers, um, they didn't have that flexibility that we were looking for, and we definitely wanted to save that cash throughout the time.
Okay. You froze up there a little bit on me. Chelsea, can you hear me? Okay. All right. Yeah. So the property management firm did not turn out to be who we expected. And so, you know what, when you buy a property and there's always surprises afterwards. There always is. And there's challenges you got to work through. It's just something that we deal with. We've worked through them. And when you deal with a challenge, usually on the back end and you look at it in hindsight, you come out stronger and in better shape anyway. So, anyway, I think, that's kind of most of everything we wanted to share here. If you've got any questions, put them in the chat. Otherwise, let's see. Mike, anything else you want to share?
No, no. To date, everything is going smooth. As you mentioned, right now, I don't know if tenants know that we actually had, in some parts of Indiana, we had about 11 inches of snowfall. So I was out shoveling the property and helping out with tenants, salting, and we took care of it fast. And tenants were happy that we cleaned everything up. But these are the things that we expected and we underwrote and took into consideration. But it's great to be here on site and to make sure that I'm managing and overseeing everything and making sure the property is being run effectively and efficiently. So that's what I wanted to add, because I know Pete, you and I had a small discussion about it, and you were surprised what happened just yesterday about the storm. So I just wanted to let everybody know that Woody Creek's still in safe hands and it's still operating and nice and clean for the tenants here. Everybody's happy.
Cool. All right. Well, I think that's about it. We did so with this property, this is really meant to be educational. One of the cool things that we did is we actually set this up legally to where it's a 506c offering, meaning that any accredited investor could actually invest in it. And so if that's something that you're interested in discussing and you are an accredited investor, you're welcome to scan it. So I'm going to put a link in the chat here and set up a call. We don't really normally accept anybody. We want to talk to people before we allow investments because it's kind of a partnership, right? But yeah, if you got any questions on that, there's the link in the chat to schedule a call with me. Otherwise, I hope you have a good day. I hope you found this valuable. And if there's anything Mike or I can do to help you out on your journey, just reach out and we're happy to help. Thanks a lot.